We've seen this before. The dot-com bubble in 2000 sent stocks absolutely skyrocketing until the NASDAQ came crashing down 83%. After the big market drop due to DeepSeek, you're probably wondering, is AI the next bubble to burst? It would be scary to see the stocks in your portfolio fall 83% or even 60%. And that's a totally normal concern. I'm going to compare what's happening now with the dot-com bubble and provide you with a sense of calm during times of uncertainty. DeepSeek, which is a Chinese AI startup, just turned the tech world upside down. Its new AI model rivals giants like ChatGPT, but operates at a fraction of the cost with less data. That's exactly what's scaring investors in the US based on AI companies and causing stocks like Nvidia to nosedive 17% in one day, wiping out $600 billion in value in a single day, the largest loss in history. Meanwhile, DeepSeek's AI assistant shot to the top of Apple's App Store, outpacing seasoned competitors and raising serious questions about US tech companies' massive AI spending. But here's the catch. While the market may be overreacting, the real challenge lies in trust. For value investors, this disruption is a reminder: don't chase the headlines. Stick to fundamentals. And remember, in chaos lies opportunity. Stay disciplined and keep an eye on the long term. I want everybody to remember, just because you're a value investor doesn't mean you don't value growth. People always want to divide value investing with growth investing. They're the exact same thing. The only difference is we're valuing growth. We're sitting there saying, hey, listen, every investment's the present value of all future cash flow. If your cash flow is going to grow faster in company A versus company B, the value of company A should be much higher than B. That's all it's doing. But I always see people saying, no, they're different. They're not different. So how does this compare to the frothy 2000 tech-driven dot-com bubble? Well, everyone's talking about AI changing the world. Guess what? It is. It'll continue to do so. It has been doing so for quite some time. And back then, the internet and every dot-com was changing the world and has continued to change the world today. For those of you who are old enough to remember what life was like in the early 90s, how different is life today versus the early 90s? How different is life today than it was in 2000? I remember in 2003, sitting in a meeting at a Starbucks, meeting with an older guy about some advertising. And the guy said to me, I've never bought anything from Amazon and I will never buy anything from Amazon. I don't trust the internet. Guys, I'm going to guarantee you one thing, that man has bought from Amazon as of now and he continues to buy from Amazon. But it was so new back then. That's how different the world is today. I remember seeing an article in Forbes where Amazon said, we want to sell everything, including dishwashers and dryers. And I sat there and said, how the hell are they going to sell dishwashers and dryers? That's ridiculous. Meanwhile, when I want to buy a dishwasher and dryer, where do I go today? I go to Amazon. Back in the late 90s, the stock market was wild and tech was star of the show. Guys, in every bubble, in every market surge, tech is the star of the show. The difference is the character that's considered tech changes as time goes on. Cars, airplanes, radio, TV, computer, internet, electric vehicles, artificial intelligence, and the list goes on and on. The dot-com bubble wasn't just frothy. It was absolutely overflowing. Imagine a party where everyone's celebrating, but no one checks the bar tab. Investors were throwing money at anything with a dot-com in the name, ignoring one crucial detail: profits. I remember watching Conan O'Brien one night, and one of the guys from 90210, he was bragging, I have my own dot-com now. Oh, what is it? They said, I sell plastic protectors for lockers, for school lockers. You put it in the back, and I'm like, that's not a dot-com. It's just because you used a website, that's what makes it a dot-com, but that's what he was doing. He was trying to run off the dot-com euphoria. Back then, companies with no revenue, no earnings, were IPOing and skyrocketing. It was speculation on overdrive, but the bubble burst. By 2000, reality hit them very hard. Pets.com, MVP.com, Webvan, all of these things gone. The NASDAQ cratered 83% and trillions of dollars disappeared. What was the painful lesson? Fundamentals matter. One of our pillars of our principle-driven investing is every investment is the present value of all future cash flow. And when those cash flows weren't appearing, guess what happened? They went to their natural value, which was zero. Now, are we seeing .com 2.0? There are a lot of similarities there. AI, crypto, meme stocks, all scream hype. But today, tech giants like Apple and Google are highly profitable, which a lot of people consider a stark contrast to back in 2000. But you gotta remember, Cisco, Microsoft, Intel, these were the poster children of back then. They made a ton of money. And the only one that's higher than it was in 2000 is Microsoft. And it's merely because their revenue and profit is 20 times higher than it was back then. With AI, it seems like you have to say those words. You have to say those letters, artificial intelligence. There's jokes about how many times you think they'll mention it in their earnings call. It's considered the new thing that's going to change the world, and it will change the world. A great story by itself is a fairy tale. Numbers by itself is an Excel sheet. Changing the world is going to happen with AI. We already see it, and we're in its early stages. 10 years from now, we're going to laugh at all the things we do now with AI. It's going to get better. It's going to be even better than we think, and there will be many winners that last the test of time. The old hype tech becomes the new blue chip, and the current hype will become the future blue chip. But the question is, will everybody be successful just because of AI? And the answer has to be obviously a no, just like it was for the dot-com era. And guys, to compare today to 1999 and 2000, the peak of 1999, 29% of the S&P 500 was made up of the tech sector. It got as low as 14% in 2002. Well, what was in 2002? The bottom of the market. Today, we're at 33%, if not higher right now. It's based on end of year data. 33%. It's worse than the tech bubble of 2000. Now, does that mean it's going to play out the same way? No, but does it make sense? Are we seeing and feeling the same things we felt back then? Even those of you who weren't around back then or didn't care back then, it's not going to be any different. It's going to have different characters, and the characters are different now. It's AI. It's EV. Back then, it was telecommunications. It was tech. All those things. Now, guys, again, I'm going to pull up 3 companies that actually did survive. One that completely crushed. But you got to remember what happened during that time. Let's go to Amazon. And here's what's interesting about Amazon. Let's go to the max chart here. Does this even look like a crash here? Doesn't even look like a crash. Guess what? It was a 95% crash in Amazon stock price. That's what happened. And Jeff Bezos is very famous for saying, listen, we saw a stock fall from 113 down to 6. And we were all like, what the hell? But then he said, we look at our fundamentals and everything was getting better. Revenue was getting better. Operations were getting better. Every metric we used to measure the business was getting better. Stock fell 95%. And that stock didn't make money for a very, very long time. That company did not make money for a very long time. Now, let's pull up the less obvious ones. Cisco. Cisco and Intel, if you go back, were the companies you had to have in your portfolio unless you hated money. So if you didn't want to make money, you had to exclude Cisco and Intel. If you wanted to be rich, you had to have Cisco and Intel. Sound familiar? All the Bitcoin people out there saying enjoy staying poor. That was a thought process on Cisco and Intel. Let's go to max chart. Does this look poor? This actually looks poor right here. The stock hasn't hit its 2000 high from Cisco. Now, you might be saying, for those of you who haven't watched the channel before, yeah, Paul, but the business sucks for Cisco compared to 2000. Oh, but wait. Let's go to the financials. Let's go back to 2000. In 2000, Cisco did $18.9 billion, and the last 12 months column, $53 billion. So almost 3 times more revenue. Let's go look at the profit. The profit, ironically, was $2.6 billion to $9.4, but the next year it actually lost $1 billion. So it's making almost 4 times more money. Okay, let's go one step further. I love Intel so much because everyone hates Intel today. Everyone thinks Intel is the worst company. Very similar chart to Cisco. Look at this. All-time high back in 2000. It's at $20 a share right now. It was at 75 back here. Down to $25 a share. Might have been higher. Nope, 75.81. Now, let's go look. And Intel's revenue has absolutely plummeted in recent years. Hit a high of $80 billion in 2021. In the last 12 months, it's done $55 billion. But let's go to 2000. In 2000, it did $33.73 billion in revenue, dropping to 26 in 2001. That's what's amazing. So what's the key to long-term investing success? Buy great companies at great prices. You're not going to buy them at the bottom. So if the price falls, if the fundamentals are the same or getting better, you continue to buy. Focus on paying a reasonable price for future cash flows. Now, if those cash flows are going to grow very fast, you need to pay a premium for that. Avoid chasing trends. It sucks. It sucks to see all your friends make easy money. Don't think for a second that I don't have the same thing when I see all these idiots I know who just put money in these random stocks and say, look how high up it went. It sucks. It sucks to hear all these morons who love Bitcoin. There isn't a single person in this world that has Bitcoin that I respect as an investor. And seeing them all print money, that's frustrating. To quote Charlie Munger, it sucks to see that happen. But we have a principle-driven investing process, and that has 5 basic pillars. First one, we're investors, not speculators. What that means is we buy assets that we can create a value for based on some sort of fundamental, whether it's cash flow or something else, not a system that requires somebody else to pay us more money, and that's it. There is zero intrinsic value to things like Bitcoin and crypto. If the market for those things went away, you'd have nothing. You might sit there and say, well, Paul, if the market for NVIDIA went away, I'd have nothing. That's not true. You'd still be a part owner of a company that's generating revenue, generating profit, and growing that along the way. Just like your neighbor who owns a mechanic shop, just because there's no immediate market to sell his shares doesn't mean his mechanic shop is worth 0. 2, every investment, the present value of all future cash flow. What that means is there's a cash flow stream when you buy an investment. The first year is negative because you laid money out. You sent money away. And then the future years, you get some sort of cash flow. It could be negative to start, going to positive. It could be positive all the way. It could be 0 if you're reinvesting. But every investment you make, the return will be based on all the cash flow you receive in the future being brought back to today. If you laid out $1 today and got $1.10 back tomorrow, next year, that would be a 10% return because you present value it back. Number 3, if we don't understand it, we don't invest in it. If you don't understand how something's going to make money or lose money, then you don't really understand anything about it. If you don't know how it's going to make money, you're not going to know how it's going to lose money. Nobody can tell us how Bitcoin's going to make money. I can tell you how NVIDIA is going to make money. So that helps there. It checks that mark there. We know how NVIDIA can make money. 4, we don't look at short-term market prices to tell us if we're right or wrong. I hear it all the time. Oh, look, this stock, happened in early 2021. Everybody was raging about Palantir back then, about ARK investments and all those things. And I sat there and said, yeah, their recent run-up has been impressive. And there were actually comments from people saying, gee, this video has good timing. And then look what happened to them. Yes, Palantir's up to 75 now. 4 years later, after falling from 45 down to 5. Where's ARK investments? It's at 60 right now after falling from 160. That's a longer term outlook. Doesn't mean that I'm sitting there saying I'm always right. Not even close. But when we saw shit stocks like Workhorse and Nikola and all these things, we're like, these things don't make any money. Tattooed Chef, these don't make any money and they don't have any justification to justifying their current market cap. It didn't make sense to us. And 5, a great story can become a bad investment at the wrong price. That's so important for everyone to understand. It's almost the most important one of all these. If you're just attached to the story, you're going to have problems because the story will change. Look how quickly DeepSeek changed the story on NVIDIA. It's a $3 trillion company, and the story was almost changed perception-wise overnight. Whether that actually happens or not doesn't matter. But literally, in one day, it lost 17% of its market cap because of one company doing something pretty interesting. Guys, just know that at some point, we will see heavy market downturns. Based on where we are with valuations today, my guess is we're going to have a very, very rough next 5 or 10 years. But don't be afraid. You need to be prepared. The key is to stick with a plan, be consistent, and stay focused on the long term. It won't be easy. It's hard to sit there and see the market go up and down like this and say you're focused on the future. But that's why you need to surround yourself with people that look at it that way. You are the 5 people you spend the most time with. I want to shift your focus from fearing stock market crashes and corrections and worrying about how to protect yourself to being excited about the opportunity to buy stocks at cheaper prices. You need to have an offensive mindset when it comes to investing. Not overly offensive, just a person who looks for opportunities. No one in this world is going to come save you. The government won't bail you out like they did with banks in 2007. You need to surround yourself with people who are headed in the direction you want to go, and you have to keep investing. So guys, if you want to be around like-minded people, join our community of thousands of like-minded investors. You can't and you should not do this alone. I cannot and I should not do it alone. When stocks fall, these overhyped stocks will fall the hardest, and most people will panic sell. In our community, when stocks fall, there's cheering, there's excitement. There are better deals on great companies. This company's out of favor. What's it looking like? What's the free cash flow? What are your assumptions for the future? That's what I'm talking about with every investment's the present value of all your future cash flow. That's why we have our stock analyzer tool to help determine those future cash flows, because it'll tell you the right price to pay based on your investing return requirements. And right now, go to everythingmoney.com/sign up or click the link in the description below. We have a 7-day trial for just $1 per day. It's 7 days to try out everything we have here. So make sure you take advantage of it while it's still here. Click that link in the description below, and it'll be the best investing decision you've made all year and a great way to start 2025. And if you're in the community, we'll be here to remind you that it's not all bad news. You don't have to endure this alone. No one can predict the future. But what we can do is teach you a process that helps you make smarter decisions over the long run. But the things that you apply this process to are going to differ than what I apply them to. But the point is, it's a common way of thinking. We're all here to become better investors. Thank you for your time.